Good morning. Bonjour tout le monde. Carol and I are very pleased to be here with you today to discuss the July Monetary Policy Report, which we published this morning. Avant de répondre à vos questions, j'aimerais vous expliquer.
Before we take your questions, let me take a minute to share our thinking around how our quarterly analysis of growth and inflation feeds into our monetary policy decisions.
Our thinking around how our quarterly analysis of growth and inflation feeds into our monetary policy decisions. I'll begin by reminding you that monetary policy must be forward-looking, and that's because policy actions take time, around 6 to 8 quarters, to work their way through the economy and to have their full effect on inflation. So let's look back to last fall, when measured inflation was very low. Total inflation was just 0.7% last October. Core inflation was 1.2%. In fact, inflation had been running below target for some time, and the economy was carrying a lot of excess capacity, which raised the risk that inflation could fall even further. At the time, even though we presented a projection in which the forecast risks around inflation were roughly balanced, we gave greater weight to the downside risks than to the upside ones. Because inflation had been persistently below target, a negative shock would have mattered more than a positive shock, as inflation would have been driven even further away from target. In short, we attached greater weight to the downside risk because inflation's starting point was already relatively far from home and had been for some time. C'est-à-dire que nous attachions plus de poids au risque à la baisse, car le point de départ.
This means that we gave greater weight to the downside risks than the upside ones because inflation had been persistently below target.
Inflation began to move up. 6 weeks ago, when we last set the target for the overnight rate, the inflation numbers we were working with were from April. Now, they showed total CPI inflation at 2% and core inflation at 1.4%. Although we had expected inflation to move up due to various one-off factors, including the effects of last year's decline in the dollar, the increases arrived a bit faster than we had presented in the April MPR. At our announcement date 6 weeks ago, we did not have a new projection in which to work out all the details and rebalance the forecast risks. The economy still had a significant degree of excess capacity, which of course acts to pull inflation down over time. Further, relative to our projection in the April MPR, we were monitoring growing downside risks on global economic activity. We believed that as we worked toward our next projection, which is published in today's MPR, we would probably be downgrading the economic outlook. That would mean a longer period of economic slack in Canada and would translate into a downside risk to inflation later in the forecast horizon. Accordingly, 6 weeks ago, even though measured inflation had already ticked up and looked likely to tick up even more, we indicated that the downside risks to our inflation outlook remained as important as before. In effect, the risks associated with the starting point for inflation had diminished, but the downside risks to the underlying fundamental drivers of inflation were growing. Today, our report notes that total CPI inflation has moved to 2.3% and core inflation to 1.7%. La hausse de l'inflation est due aux effets temporaires des prix de l'énergie plus élevés, de la transmission des variations du taux de change et d'autres chocs sectoriels. Elle ne découle pas d'une modification des facteurs fondamentaux propre à l'économie canadienne. Today's MPR presents a new economic projection in which there are both upside and downside risks to the inflation outlook. We believe these risks are roughly balanced. The downside risks to inflation associated with a below-target starting point have clearly diminished. The projection now includes a lower track for global economic activity and a slower return of our economy to its full potential. Our serial disappointment with global economic performance for the past several years, of course, means that we remain preoccupied with downside risks to economic activity and the fundamental drivers of inflation. As the temporary effects pushing inflation up today begin to dissipate during 2015, unless the economy's slack is absorbed over a reasonable time frame, inflation will drift back down well below our target. This will require above potential economic growth, fueled by rising exports, followed by investment in new capacity. Now, we believe that the ingredients are present for an eventual return to balanced and sustainable growth with inflation on target in 2016. We are anticipating that global demand will strengthen and, with the lower Canadian dollar, indeed, will lead to a pickup in Canadian exports and business investment. Nous prévoyons que la croissance du PIB réel va s'établir en moyenne autour de 2,25% en 2014 à 2016. L'économie devrait retourner à son plein potentiel vers le milieu de 2016. C'est un peu plus tard que prévu en avril. En même temps, les déséquilibres dans le secteur des ménages continuent d'évoluer de façon constructive. Les données récentes concordent en général avec un atterrissage en douceur du marché canadien du logement. For the inflation target to be achieved on a sustainable basis in 2016, the economy must reach and remain at full capacity. Closing the output gap over this time frame is reliant on continued stimulative monetary policy and hinges critically on stronger exports and business investment. Now, weighing these considerations within the bank's risk management framework, the monetary policy stance remains appropriate, and the target for the overnight rate remains at 1%. Now, the bank is neutral with respect to the timing and direction of the next change to the policy rate. This will depend on how new information influences the outlook and our assessment of the risks. And now with that, Carolyn and I would be pleased to answer your questions.
Okay, we have about 20 minutes for questions. If everyone can keep it to one question, one follow-up, and then we'll, if people want a second turn and there's time permits, we'll do that. Greg Quinn, Bloomberg.
Good morning, Governor. I noted your statements on serial disappointment in global growth and how Canada has to rely on monetary stimulus because of weak exports and business investment. Given that, have you given any thought or do you see any benefit in possibly reaching back to the old toolkit and stating outright that maybe interest rates are going to remain low until we see global demand pick up in that rotation to exports and investments? Would that be helpful to companies who are uncertain about where things are going?
Well, the projection that we've laid out has us getting, as I call it, home, you know, with a convergence of both core and total inflation on 2%, and our excess capacity used up sometime in 2016, around the middle of 2016, so which is approximately 2 years from now. That's close enough to the kind of 6 to 8 quarter horizon over which we can actually conduct policy. So that suggests to us that if we have monetary conditions set about right at this stage, and with our other analysis of the global outlook and around exports and so on, that we will get that sustainable growth emerging over that time frame. Now, we're not totally indifferent to that horizon. So if we redid the whole thing and it was either 6 months longer or a year longer, then we would want to talk more about what other risks that was throwing up. Would that be the risk that inflation would then track back down, say, to around 1 or a little above 1%, that kind of thing? That's where serial disappointment could still come back to us. It's the sort of thing that one can't really prepare for in a forecast. You believe all the ingredients are in place, and that the delay primarily seems to have to do with uncertainty on the part of businesses. It doesn't seem to be uncertainty about interest rates per se. It seems to be uncertainty about whether there's a durable recovery that one in which they can plan on a long-term business. And I don't think the cost of credit to them is one of the key variables holding them back. It's a more fundamental thing, and it has more to do with what we've been through in terms of business experience, and therefore a reluctance to overcommit when there's that much uncertainty globally, and of course that translates directly domestically.
I want to touch on where the MPR mentioned the job market, because the MPR said it suggests a lot of slack in the economy, and you mentioned that what's holding down unemployment is people leaving the labor market and not job growth. We've seen the government give a message about how strong Canada's job growth has been within the G7, so I'm wondering how do you explain that contrast, and how does the weak job market fit into the risks you're talking about to the broader economy?
Right. Well, to start with, there's no question that we have had a good labor market performance relative to other countries in the wake of the global downturn, and so this is not something to debate. The real question that we have is, are we getting enough of one to use the excess capacity which is present in the economy, since that is the key variable which determines that longer-term outlook in inflation. And so right now it would appear that we have substantial excess capacity, substantial room to grow, whether one looks at the output space, which we call the output gap, or if one looks at the labor market space, which would be unemployment, the discouraged worker effect, the exits from the workforce, all those, which is why we bring some attention to that in the MPR. There's really two ways to look at it. Carolyn, would you like to add anything on the labor market side?
Sure. I mean, as usual, we look at a variety of factors when we look at economic slack, not just the output gap, which we see right now at about 1%. But when you look at the unemployment rate, which is at 7%, and you factor in this sort of discouraged workers or discouraged searchers, as the measure is that we have in the MPR, you see that in fact there is quite a lot of slack. And you know, if you think about what kind of growth in employment we've had over the last year, on average, it really isn't consistent with growth that you would see that's consistent with growth in potential output. And when we look at wages, you kind of factor in the slow growth on the employment side and sort of relatively modest wage growth. You can see that labor costs are even growing more slowly, which is really another factor that we need to look at. So all told, the economy does seem to have considerable room to grow.
Okay. Nirmala Menon, Dow Jones.
Governor, what would you say to those who would say, I mean, you've dropped that concern about low inflation in this. What would you say to those who say that you're just swapping one excuse for another to keep rates low? You've got your serial disappointment in global growth now. And I'm also wondering, I know you said specifically it's neutral, that you're on neutral. Are you more, is this real neutral? I mean, does it mean that that there is less likelihood of the overnight rate going below 1%? Because I'm trying to figure out what your stimulative policy here refers to. Is it more fact of what 1%, that rate remaining there for a long time, or whether it's going to be lower?
Okay, so monetary conditions today are highly stimulative, and it's evident that we don't have a process of natural growth in the economy yet. We have some. We certainly have some natural growth emerging in the energy side of the economy, lots of new investment, growth in output, growth in employment, et cetera. And so that's one area where, and that spreads, it's the sort of thing that can be catalytic, so it's a positive thing. So we believe we are already very stimulative, and so we're waiting for the full effect of all those things to come together. But the fact is that whenever we present you with a new forecast, it has both upside and downside risks in it. That's the nature of a forecaster's job, is to balance the risks that they see, so that the projection that you see there for inflation is our best offering. And so, of course, there are risks ideally symmetric around that. So that's why those fan charts that we show near the end of the MPR are there. So we put box 2 into the MPR this time to help sort that type of risk out of the other type, which I've quickly called starting point risks. So like last year, it's clear that inflation had been quite below target for quite a while and was still drifting further below target at a time when there's already fundamental pressure downwards on inflation. So in that context, starting your forecast for inflation from a point that low to get home, it's pretty clear that if the wind continues to blow in that downward direction, you're going to get even further off course. So even if you're symmetric on your risks, a downside risk has a much bigger policy implication than an upside risk. Because if you had an upside risk, it would just put you closer to the path that you wanted anyway. So as I said before, picture yourself crossing a lake in a boat and the wind blows you to the right. You're much less concerned if the next gust of wind blows you back to the left than if another gust pushes you even further to the right. You must then steer to correct your course. And so all that by way of saying that we are neutral right now because inflation is roughly on target. It's a little below target. And of course, if we look through the short-term effects, it is still below target, but it's enough in the zone that we don't have to be thinking that the next shock is going to take us substantially off target. And so with that, we start with a balanced forecast, and we can say, well, now our thought process depends on the data flow. Okay, so if the data flow takes us further below target, then we'll have to talk about what policy response is appropriate. If it were to take us further above target, we'd have to understand that in the context of persistent excess supply. So all those things go into that risk management framework that we've talked about each time.
Keeping rates low, if it fuels risk-taking such that financial stability becomes an issue, would you then be prepared to hike rates, or is that something that you think should be addressed through a macroprudential regulation?
Well, we try to take these things into account, but we know that monetary policy is not the first or even the second line of defense against financial stability issues. There are things we need to take on board if we observe them. And we have a degree of flexibility, as I alluded to before in answer to Greg's question about how long it takes us to get back home. If a little bit slower helps us manage a financial stability risk, then that's okay, or a little bit faster would help us manage. So we would take those things into account, but those are things that don't actually put our target at risk. So it's a question of whether or not the issue you perceive as a financial stability issue requires the use of macroprudential or other tools. Those aren't our tools, but we're part of the advisory group that talks about those things. So the fundamental answer to your question is it depends. It depends on all those ingredients. How important is it? In my perception, financial stability risks have not been a constraint on monetary policy to date. But what they have done is they've informed it. And if you look a little bit at history, 20 years ago, we thought that keeping inflation on target would keep us out of trouble. And what we've discovered is it wasn't quite enough. It was necessary, but not sufficient to keep us out of trouble. And so this gradual increase in attention being paid to financial stability issues and their modeling and their incorporation in the policy framework is a reaction to that it just wasn't quite complete. But the real tools of financial stability are separate from the monetary tools.
Bob Fife, CTV.
Governor, you mentioned the two principal reasons for the slower growth seem to be exports. Is that a result of the U.S. economy still not growing enough? And the second, lack of business investment. Corporate profits are still pretty good, so I'm assuming they're hoarding it. Why are they hoarding their money?
So all these things, I think, connect well together. that in fact, globally what we see is low investment. It's not just us. It's not just North America. It's a global issue. My interpretation of that is that the whole world went through the trauma of the 2007-8 crisis and the aftermath. And so that sense of uncertainty, and is it real? Will my board let me make a big investment until we're really sure? Those kinds of things enter those business investment decisions. And coincidentally, business investment, that's about machinery and equipment, which is a highly trade-intensive segment of the global economy. And so we think that that's the common factor that's holding down growth in total trade around the world. So now we can connect that back home. Certainly in the U.S., we're seeing, some of the starting point issues, some of the investments starting to happen, not broad-based, but there's a glimmer there, which is encouraging, yet not necessarily a new trend. Similarly for us, as I said, we can see it in things like in the energy sector. There's definitely good investment decisions happening in there, but there's still that perceived reluctance. And so that uncertainty holds it back, and it means that firms have had an opportunity to strengthen their balance sheets. They've refinanced themselves at lower rates. They really are ready if the upturn does become self-sustaining and real in their perception. And it's why we sometimes refer to animal spirits, because if your animal spirits have been crushed in the sense that Keynes talked about way back in the 30s, it takes something to cause it to flip to a positive. And when it does happen, though, what happens is everybody kind of catches it at the same time because it's self-reinforcing. So our base case is that momentum is gradually growing. So investment will begin to pick up, trade will be picking up at the same time, and that Canada will almost certainly get a piece of that in our export picture. Our extra layer of concern, though, is that our exports have not moved in sync with the U.S. economy as well as they have in the past. So the linkage isn't necessarily certain. It's less certain than in the past. So we have an extra element of uncertainty or downside risk to our discussion, which is why that's one of our risks at the back of the MPR. But all things considered, it looks to me like the investment categories like machinery, equipment, building, packaging materials, the aerospace sector, some of these are ones that seem to have behaved roughly according to our normal models. And so that suggests to me that as investment picks up in the U.S., we will see the results in at least some of our export sectors.
Now, you're doing your part in terms of keeping interest rates low to keep the economy growing. Is there something that governments can do, and I don't mean just federally but provincially, in providing the kind of investment, targeted tax credits to get businesses to actually invest and create jobs rather than sort of just lowering rates overall, but rather having targeted investments so that you encourage people to take that money they're sitting on and actually spend it?
Well, I won't comment on appropriate fiscal policies. I think Canada already has one of the best investment climates in the world, and I think that it's not the costs of investing or anything like that that are standing in people's way. It is more this uncertainty issue, and so that may just require a little bit more time for Mother Nature, that healing process. But I also would go back up to the 50,000-foot level and just mention like what the discussions are like at the G20 are that there are still a lot of, if you like, impediments to growth in not just in specific countries but at a global level, which if removed might give us free natural growth. And we say free in the sense that you don't actually have to do a fiscal shock in order to do it. So examples like trade liberalization are very powerful ways of boosting growth everywhere at once. And so when the G20 committed to raising the level of global GDP by 2 percentage points over the next 5 years, that's a very meaningful commitment. They're now each country working on the list of things that might help contribute to that. It's not a growth rate. It's very important that it's a level effect. But that's a couple of $1 trillion globally. It's a really significant amount of money that's available, perhaps, if we remove some of these impediments to growth. But that's not trying to incent it or doing fiscal things to try to force it to happen.
Julian Beltram, as Canadian Press.
Good morning, Governor. A year ago, if it had been you sitting at that desk.
It was, actually.
You were, that's exactly.
That was my first one.
The forecast would have been that the economy would have returned to normal or full capacity in mid-2015.
Yes.
Now here we are a year later, and it's mid-2016.
Yes.
You can do the math. That suggests that there has been very little progress.
That's right.
In the recovery. I'm just wondering, and you talked about how you need to stimulate interest rates. Just what exactly, how much of the ball are interest rates carrying, and where would the economy be without them?
Well, first of all, your preamble is a nice summary of what we call serial disappointment. And so if one looks at charts of the updating process, like for example from the IMF or something, at a global level, global activity, each year for the last 4 years, we thought, well, next year is going to be the recovery year, and then it gets put off by a year. So it looks like this series of upturns that don't quite get started. And so we aren't alone in this. And so it's not something like that we could have maybe talked about a year ago in this room. We again, when getting back to Bob's question, underneath this, it's not some failure of a model to make a forecast or that. It's regular people, business people that need to make decisions that cost a lot of money and could fail if they're wrong about their assumptions. And so having been through what they've been through, they wait a little longer to make it a little clearer. But if everybody does that, then it takes longer. And that's the nature of the serial disappointment. So again, I think that the process is more like a healing process than one that suddenly turns like an elastic band, which is more the way we typically thought of economic cycles. You push something down, and then of course there's this natural force which is bringing it back, and it kind of comes back all of itself. What we believe is that the world has a natural growth rate, and that we're trying to get back up to it, but there are at least 3 headwinds that slow down the progress back. One that I've talked a lot about, I think is the most important, which is that wedge of uncertainty. But the others are the deleveraging effect among private sector, not just households, but let's say primarily households, but also businesses, and for that matter, the financial systems, if you like, in Europe. So deleveraging is a fact. It's something that we can observe, and we can observe as we do in the report that maybe it may have run its course, or at least that headwind should be dissipating. But you don't really know how far people are planning to delever. It just looks like they're back more like where they used to be, so that should be about right, but you don't actually have an anchor for this. And the third thing is, of course, fiscal consolidation, which has been an important element of this phase of the recovery, because there was a lot of fiscal action, which of course is unsustainable for a long time, and then you begin to put things back on track. So those headwinds, looks like the last 2 that I just mentioned, are dissipating. So we would expect the law of gravity to be pulling us up. And the uncertainty one is probably the most important remaining one. But if we get just enough of that momentum, then that'll start to go away too. This seems like a natural process, and we are laying it out in a conservative manner in our forecast. But as I highlighted in my opening remarks, serial disappointment is something that just, you kind of wear, but you can't actually acknowledge somehow in the numbers of your forecast. But you're prepared, having been disappointed several times in a row. It kind of gets you to thinking, well, what are the signs to talk me out of it again? We just see some encouraging signs, but they aren't enough to start betting a forecast on.
Okay. Gordon Icefield, the Financial Post.
Hi, Gordon. Julian stole my question, so I'll elaborate on it, or ask you to elaborate on it. It's been 3 consecutive monetary policy reports where the output gap closure target has been moved back. Can you crystallize the most important element to those pushbacks? The most important.
Sure. The most important thing has been the failure of exports to recover. And by, I should be precise, non-energy exports, because energy exports have indeed been quite strong, and we'd expect that to be a trend, a continuing trend. There's no question that with higher global prices for energy, higher Canadian terms of trade, that's one positive natural force that's working its way through our economy, and we see a two-track economy that we've talked about in the past, two speeds. It's the other part that's slow, and that's connected to the failure of exports to recover. That is in turn connected to two things. A, the world, the serial disappointment of the world, and of course the U.S. part of that. And secondly, the wedge between that and our export performance, which has not been a constant. So even though there's been some recovery, we haven't benefited as much as historically. So, so for us moving forward, the transition to sustainable growth means that we no longer have an excessively strong housing market, so things are calming down there, and that gets replaced by stronger demand for our exports. And following that, companies that have plenty of money ready, discover, yes, we don't quite have enough capacity to fill all these export orders, and so we'll invest now too. And so you get not just more capacity, but a modernization spending, which causes costs to fall and the competitiveness improves, and it's a self-reinforcing story. So those are the ingredients that we see are in place, and we're just kind of watching for them to come. And if we look at the charts, say a year ago, I thought it should be happening already. We have dug down further and discovered that for about half of our non-energy exports, behavior looks about normal, so we're expecting that to move. It's not just, of course, demand, but the lower dollar will play into that. It gives them stronger balance sheet, and it also gives them a stronger Canadian price for what it is they're selling, at the same time as offering a lower cost to the buyer. So it's a combination that fuels that. As I've said, the icing on the cake being the demand in itself. So that of course is where we hope to be. But the other half of the exports are languishing and have done so for a longer period of time. And so here we dug down a little deeper, and we see evidence, for example, that in the auto sector, we have lost market share. We are losing market share in the U.S. market to Mexico. So we know it's not a surprise. We know Mexico has attracted more investments in the auto sector than Canada has. Well, it's showing up in the export data. And there is also an secondary effect on parts, because the parts suppliers tend to add capacity close to the assembly plants for logistical reasons. Also chemicals, certain wood products, pulp and paper. So there are other areas that are languishing in this sense. So our forecast is that they've more or less done losing market share, that they will benefit from, if you like, the generalized lifting of all boats. But of course there's a risk, which is highlighted at the end, that they don't. And so if that continues to trend downwards, we will still have an issue, and exports will not be sufficient to fill that gap, the gap that you're talking about.
We might be having the same conversation in 3 months, perhaps?
Well, that would fit under serial disappointment, and if you hear me say it again in 3 months, then it'll be true. I got to say that we did get in the last couple of months, the trade data had some elements that were encouraging in that sort of space that we're watching closely, and so, but we've seen false dawns like that before, so we don't want to start betting on that. And as I said, there are other things that can easily offset it. So we're being cautious on that, but we've got to wait and see. And certainly I remain hopeful that that the pieces are in place and that we'll see this action happening.
Pasi Kapelos, Global.
I'm just wondering, you talked a bit about the lower dollar there and the effect on exports. I'm just wondering if you have any concern that we did see it swing up. We have seen it swing up a bit over the last month, and how confident you are that it will go back down and have that positive effect on exports?
Yeah, well, certainly we should begin the story with the dollar is, regardless of what it is today, it's lower than it was, and so the dollar always fluctuates wherever it is. It never seems to sit still for very long. So much of what we have to do is when we're constructing our forecast is we're going to put the current or most recent value of the dollar in and take it into account. And that gives us the forecast as we described. It is obviously a very important variable because it feeds directly into the export sector, both through cash flow and through the price that customers perceive. And so when we're finished, we say, okay, conditional on that assumption about the dollar, this is what we get. Of course, if the dollar moves, then it would require a new analysis of that. And we are saying quite clearly, I think, that the export sector is a really important part of how we get home. Right now, we do not have a sustainable growth picture in Canada. Over time, we know the energy sector will get bigger and bigger as a share, but it seems unlikely that it will be sufficient to fill all the wedge of exports from the other sectors. So the dollar is critical to that analysis. There's no denying that.
Got one last question, second round, Nirmala.
No, that was, actually, I was going to ask you about the dollar as well, so, yeah.
Any other questions? Thank you very much. Merci beaucoup.
Thank you. Grand merci.